All right, hi everyone. Welcome to day 2 of the 2025 Profit Playbook. This is Synergy Traders event number 54, and this is our annual Friendsgiving event. So most of our favorite presenters, favorite educators back to give you their best education for the year ahead. So this event is brought to you by TradeOutLoud.com and TimingResearch.com, and along with our co-sponsors for this event, which would be OptionProfessor.com, TradingIndicators.com, MadHedgeFundTrader.com, AlphaShark.com, BubbaTrading.com, AltaVest.com, TradesTrending.com, and LogicalSignals.com. So, of course, these presentations are for educational purposes only. Trading is not suitable for all people, and please consult a financial advisor and only trade with money you can afford to lose. All of these sessions also will be recorded and available on TimingResearch.com, as well as the Timing Research YouTube and Substack. So today I've arranged for Jake Bernstein to be our opening presenter for this day 2 of this event. So I'm going to go ahead and turn it over to Jake. Hi, Jake. Thank you. Thank you for being here.
Thank you for inviting me, David. I appreciate that. And you said we got about 45 minutes to an hour. Is that right?
Yes.
Okay. I'll do my best to teach people everything I've learned in 57 years of trading in 45 minutes. Let's see if we can get the job done.
All right. Sounds good.
So thank you for attending wherever you are in the world, whether it's today, tonight, or already tomorrow. Welcome aboard. I will share with you some of my experiences that will, I believe, help you become a better trader, but it's going to take work. We know that for sure. The good news about trading is that trading is all about patterns. Patterns are all over the place. If you go to the internet, you go to your browser and you say, teach me how to trade, you will come up with, and I kid you not, at least 500 million hits, millions and millions of things. Imagine the plight of the new trader who goes to the internet and looks for teaching materials to learn trading. They will be absolutely overwhelmed. The good news, there are many ways to trade. There are many trading patterns. The bad news, there are too many. And the fact of the matter is that most of them are bogus. They do not work. How do we know that? Well, you've got a wonderful little tool called a computer. Any trading methodology, any strategy, any system can be put on the computer, and you can ask the question, does it work? If you answer the question, does it work, with we don't know, or we can't program it, there's a problem. The reason you can't program something is because it's not algorithmic. It's not based on rules. If it's not based on rules, it's not going to work in the long run. The answer to that? Just use a small amount of data. Show a backtest over the last 10 trades, the last 20 trades, the last 30 trades. And the farther out you go into the back end of the data, at the beginning of the data, 10 years, 20 years, 30 years, 40 years, 50 years, the worse most methodologies look. Over the short run, they may look great, but over the long run, they look terrible. So trading is all about patterns. What's a pattern? Example, head and shoulders, reversals, key reversals, flags, pennants, breakouts, Fibonacci, Elliott wave. These are all patterns. If you put the pattern on the computer, as I said before, and you ask the question, does the pattern have predictive validity? Does it predict anything? If so, how far out into the future? If so, give me the numbers. The developer of that strategy comes back to you and says, I can't give you the numbers. Why not? Because it is not able to be programmed. Why? Because the rules are not clear. Because the algorithms are not clear. The if-then is not clear. Trading is all about numbers. If you don't have the numbers, you don't have anything. You may have intuition, but intuition won't make you a consistently profitable trader. So that's the first strategy that you have to overcome. Your strategy must be expressed specifically in rules. If you can't do that, you're never going to make money. And if you do make money, it's going to be out of sheer dumb luck and that money's going to disappear. It's not going to last too long. It took me 15 years, starting in 1967, which is a lot older than most of us, most people here are today. It took me 15 years to learn what I was doing wrong because I didn't have any books. I didn't have any strategies, didn't have any teacher, didn't have any mentor to tell me that what I was doing was totally wrong. I was making decisions based on intuition, based on an evaluation, based on assessment, based on an analysis. There is no such thing as far as I'm concerned. Does that mean there are not traders who are intuitive? Yes, some traders are intuitive. They're very good at being intelligent psychologically or emotionally. But when it comes to trading, they really got nothing, which is why so many traders come and go. What are the main reasons for losses? As I say up here in the headline, why traders lose? There's at least 100 reasons why traders lose. How traders win? There's a very few things they do. So if you think about it, there's 100 ways to lose money. There's just a few ways to make money. People say, learn from your mistakes. Every time you take a loss, it's an expensive lesson. Take the lesson that you learned and don't make that mistake again. That's easier said than done. You take the loss, you learn from it, you're going to say to yourself, I will never get out before my stop is hit or before my target is hit. The next time that trade comes around, you have an opportunity to make the same mistake or not make the same mistake. You lose money. You realize through long and deep thought, the reason you lost money is you didn't make the same mistake, but you made a variation on the theme of the mistake. As Jesse Livermore said, bad trades and errors not only have brothers and cousins, but they have uncles and aunts too. They're all in the same family. What about making money and learning from that? I'm a strong proponent of keeping a trading journal. Write down everything you did, step by step by step, what you were thinking, what you were feeling, what you were supposed to do, what you did do, and then take a look at it in detail. Learn from your profits, because you will learn more from your profits than you learn from your losses. Remember, education is not about learning what not to do. It's about learning what to do. So if you make a profit, study that. What did you do right? Where did you get in? Where did you get out? Did you do everything right? If you did, learn from it. So I won't lecture you with that very much more, but I do want to show you a few things. In order to trade successfully, and by the way, very important, you can lose money trading, as David said. And everything we do here is for educational purposes only. Remember that investing and trading with patterns, it should say with patterns, is a process, not an event. Let me share something with you. Here is a chart that I made of S&P 500. You will notice the chart goes all the way back to 1960. So we're already covering a vast amount of research, a vast amount of history. Most traders don't even go back 10 years. I want as much history as I can because only then will I have confidence in my trading. If I have confidence in my trading, I will have discipline. If I have discipline, that will give me more profits. More profits will be encouraging to me and will tell me, you did it right. Make another trade. You're confident that it's going to work. It does. You make money. You get more confidence. If you get more confidence, you get more discipline. If you get more discipline, you make more money. I want you to think about that. I'm going to say a lot during these 45 minutes. I will not have time to take questions, but if you want to reach me, you can always send me an email. Rules-based trader, that's RULESBASED TRADER@gmail.com, and I'll answer your question the best I can. So let's go back to the graph. I've taken every year of S&P futures, S&P cash and futures, and I take each year. I make the high, mathematically, I make the high of each year equal to 100. I make the low of each year equal to 0. In other words, I use a process called normalization. Anyone can do this. It's very easy to do. So what's shown here is this. No 1 year, but the true DNA of the market. This is exactly what the market has done in the typical year without looking at any 1 year or 2 years or 10 years. It's a pure trend and says this is the behavior of the market. Most years begin toward the low of the year and end toward the high of the year. And in this chart, I've done a few more things. I've taken each year and I've given it percentages in the boxes. In the boxes, you see a number. For example, here, 68% with an arrow up, meaning very simply, 68% of the time, the third week of April, prices have gone up compared to the last week, the previous week of April, 68% of the time. Now, 68% profitability accuracy does not mean 100%, but over the course of over 100 years means a lot. In fact, our data can go back all the way to the 1880s. In this case, we go back to 1960. Most traders won't do this. Why? Because they don't want to see what happened. They only want to see what the last 10 years look like, the last 5 years. And that, my friends, will not give you the whole picture. You'll notice that some weeks have arrows up, some weeks have nothing. Some weeks have no arrows down. In fact, there aren't any arrows down. What does that mean? It means, factually, since 1960 in S&P, there's not been a single week that's been predictable on the downside. I didn't make it that way. That's just the way it is. Typical year, beginning toward the low, ending toward the high. But here's what I am interested in. I'm interested in this. For example, let's go to the last 2 weeks of August. If we go to the last 2 weeks of August, you're going to see 2 weeks with arrows up. This is a predictable move. I'm only interested in putting my money on something that can be predicted, that is based on numbers. Is there anything else that's interesting here? Well, you've got these 4 weeks in January, February, separated by 1 week of not predictable. The others are all predictable. And then we have some weeks that are very high in probability. For example, right over here, November. Oh, guess what? It's that time, huh? In November, first week, 70% of the time. And then toward the end of the year, 64% of the time and 72% of the time, the last 2 weeks of December. Now, please note, my friends, this is not a forecast. It is not a sure thing. It's a trigger. It's a setup. It's a pattern. I need to be able to trigger this pattern with something else called timing. But this is the big picture. Now, if we take this big picture, or what I call market DNA, the market is pre-programmed to do this, and I compare. How does this year look with the predicted year? This year over here was not considered in the statistics here. So this is what was expected, and this is what has happened from the beginning of the year until mid-November, which is where we are now. So if that's the case, you still have time to go for the end of the year rally. So let's take a look at that. Here's the good news. This pattern is algorithmic. Anyone who's got the data can generate the same results. And the best news is this. You will notice toward the end of the year, most of the weeks are on the upside. And this, the line plot, is on the upside. What it says is very simple. Right now, today, we're in the most bullishly predictable time frame of the entire year. That does not mean it's going to look like this exactly, but it's a model, and it's a model based on numbers, not on opinions. I am never going to look at the market and say, it looks like it wants to go up. It looks like it wants to go down. What the hell does that mean? What does it looks like mean? What looks like something to you might look like something totally different to me. So I never use looks like. And besides that, how the hell does the market know what it wants to do? I have no idea, but I do have ideas of numbers. So how do I take this basic trading model? I'll show you. I'm going to go to the next slide. And here's another model. Here's another pattern. This happens to be a pattern in Bitcoin versus US dollar. These are cycles, another pattern, and they can be proven mathematically. So I'm never going to work with something that can't be proven mathematically. For example, to me, Elliott wave cannot be proven mathematically. To me, flags, pennants, and breakouts cannot be proven automatically or specifically with clarity or mathematics. So what about the 50-day and 200-day moving averages? A lot of people use that. They say that if the 50-day moving average is above the 200-day, we're in a bull market. If the 50 is below the 200-day, we're in a bear market. The crossing from above the 200 to below the 200 is the so-called death cross. Crossing from below the 200 out, going above the 200 with the 50 is the so-called golden cross. What if you took those and put them on a computer? One moment, please. What if you took those and put them on a computer and said, computer, does this work? What will you find? Well, first of all, you'll find it's easy to do, easy to program that. Second of all, you will find this. In the long run, the emphasis here on the words long run. In the long run, you will make money. In the short run, however, given the fact that this strategy can lose and has lost 16 times in a row, by the time it starts working, you're either out of money, out of patience, or dead. So the bottom line is, it works, but how well? So we're looking for patterns that have predictive ability, predictive decision probabilities, and furthermore, patterns that do make money before they have lots of drawdown. All of these are programmable. So here's a forecast, the cycle. You will notice the cycle is not symmetrical. It doesn't always peak in the middle. It's not a sine wave, but it does say something very important. What did it say? It said that by the end of 2024, we will have made new highs in Bitcoin, and in fact, we did. So now you're starting to look toward the end of the year for a decline as prices give up some of what they made. That's a forecast. But a forecast is a pattern. Every pattern needs a trigger. Let me show you what I mean. Let's go to my trading model. By the way, if there's only one thing I can teach you today, if there's only one thing I could teach any of my trading students, it's this: setup, trigger, and follow through. And let me explain to you what I mean. The setup, it's a rule, it's a pattern. I've showed you a few of those patterns. I can show you more of them. As I said before, there are many patterns. Most of them are worthless trash. In fact, 95% of them don't work, and they're designed to do only one thing: make money for the promoter of that pattern and help you lose money. So if your pattern is not specific, excuse me, if what you're doing cannot be put into a specific rule or rules, and it can't be programmed, if it can't be programmed and it can't be put into rules, you must not use it. So you're going to either believe me now, or you already believe me, or you're going to believe me later. So setup is a pattern. Number two, trigger. Every pattern needs a trigger. The trigger says, yes, even though this pattern has been right 70% of the time for the last 50 years, what's to say that it's going to be right this time? You look at an indicator, and I have my favorites like momentum, and then if the indicator says yes, the trend is up, and the pattern says yes, the trend should be up, you have a setup and a trigger, and then you've got a trade. You make the trade and go to step number three. Step number three is follow through, which is extremely important. Follow through is basically a strategy where you say, I have a first profit target. I'm going to take some money off the table. Number two, after I've taken some money off the table and reduced my probability of losing money, I go to my risk management and I find a way, and there are specific ways that I use, 3 of them at least, which will help me maximize that profit. In other words, how do I turn that $400 profit into a $4,000 profit? One of the shortcomings that traders have is this: they're so afraid that they're going to lose money As soon as their strategy starts making money, they get out and they say, I walked away from another trade and made money. They watch that trade, which made $400, turn into $4,000 trade in the next 3 days, and they say, why did I get out? Why did I do something so stupid? So the three aspects of this process that I use, setup, trigger, and follow through, are all extremely important. I'm going to give you an example of that, but let's do this. There's a lot of ground to cover, so let's do that. So here are some charts for my forecast for 2024. And by the way, I'm having a forecast webinar for 2025. I think it's going to be next month. So if you want information on that, go to jakebernstein.com, my website, jakebernstein.com. So let's go forward. Look at this chart. We're switching concepts. We're moving to a different concept. On the top of the chart, I've got a cycle. The cycle happens to be in gold. The forecast was very specific. Now at the bottom of the screen, I've got an indicator line that's in blue. It says moving average 3, but it's not a 3-period moving average. It's a 3-period moving average of an indicator. I want you to look first at this. I put a vertical line every time the indicator was below 20. So here, and here, and here, these are all indicator lines that were below 20. I took a golden line, a yellow line, and correlated it with the low in the indicator to the low in price. Take a moment and look over the chart. Low in indicator, low in price. Low in indicator, low in price. Same here, same here. In every instance, the indicator low correlated with the low in price. Very interesting, fascinating correlation here because it's been right most of the time. So what is the indicator? Some people will say, oh, it's RSI, it's MACD, it's stochastic. No, it's none of those. In fact, it is not based on any indicator that most people have ever heard of. It's the daily sentiment index, small trader opinion. In other words, when a small trader was very bullish, shown by the top red horizontal line, that correlated to the high in prices or was a leading indicator. When the small trader was very negative, which I showed you, that correlated almost perfectly to bottoms. Take a look at the chart for a few minutes and see for yourself. It's not perfect. It's not a trading system, but it's an indicator that very, very clearly predicts direction of price, which is very important because you certainly want to know where you're going to. Interestingly enough, this indicator, which is only available for me, the daily sentiment index, is subscribed to by probably 50 to 60 of the top hedge funds in the world. They wouldn't be without it. And here's the cool part. I never even advertise this index. I use it primarily for my own trading, but we can talk about that sometime in the future if David invites me back. Let's go to the next slide. So we're going to skip that slide. Let me show you another pattern. Here's a cyclical pattern in interest rate futures, short-term interest rate futures, $0. At the bottom of the screen, we have market sentiment in blue. You'll notice market sentiment was very low here. And as a leading indicator, the bottom came a little bit later. Here, market sentiment was very low, correlated almost perfectly to the bottom in price. Here's the market sentiment was very high, correlated almost perfectly to the top of the pattern, and so forth. But what's this green stuff over here? This green stuff is the commitment of traders report, commercials net long positions. What does that mean? It means, and I explain this, by the way, in my webinars, it means that sum total difference between commercial longs and commercial shorts. So what does this mean when it's green? It means when it's green, commercials are buying. The key here is, who the hell are these commercials? The Commitment of Traders report, which most people have never even heard of, comes out once a week, free of charge, public information, at the CFTC, Commodity Futures Trading Commission. And what it tells us is the net positions of three basic groups of traders: small speculators, large speculators, and commercials. I'm not interested in what the small speculator is doing. And remember, that's not the daily sentiment index. Small speculator is something different. I'm not interested in what the large speculator is doing because they will change their position. And by the time you get the commitment of traders report, it's already 2 weeks old. But what I am interested in is commercials. Commercials run 90% of the market. They're the institutions, the enterprises, the individuals that basically control the market because they trade such large positions. As an example, in the corn market, a commercial would be a producer, a farmer, a grain elevator, a grain processor like Archer Daniels Midland, and so forth. In the banking business, the financial futures, a commercial would be an insurance company, a bank, a hedge fund, a corporation that needs to hedge their money for very specific business practices and so forth. So if commercials are net long the market, which they are here a number of times, it's a prediction that the market is going to go higher. In other words, it's another pattern. So these are some examples of patterns that we use: cycles, seasonals, commitment of traders report, and so forth. With regard to seasonality, I showed the previous chart we started this session with. So review, setup, trigger, and follow through, and then we apply timing. Example, if I have timing indication that a market is topping, my last indication would be the trigger. Here is a trigger of what I call the moving average channel, showing in orange here, where the market began to turn bearish and where we got a trigger to go short right over here. It's been short ever since on this particular chart. So as you can see, I'm giving you a quick rundown of some of the tools that we use. Here's another chart of commercial activity, in this case, soybean meal. And if you spend a few minutes and look at this chart very closely, you'll see that every time commercial activity has been net long the market has gone up. Almost uncanny the way these two correlate. So if you're not using the commitment of traders information for your intermediate term or long-term investing, you're missing out on a whole bunch of important activity and a leading indicator. But let's go on to something else for a moment. I'm going to skip over a bunch of these. By the way, this is a gold chart. For many years, commercial traders have been net short or hedged on gold until right over here in September, August of 2018. Commercials were buyers of gold, net buyers of gold, for the first time in many years, and look what happened thereafter. Now, this doesn't mean that every commercial is long. It simply means there's a balance. If there are 100,000 contracts of gold outstanding and 50 of them, 50,000 are long, 50,000 are short, the COT is zero. But if 60,000 are long and 20,000 are short, then you have a net difference between the two, and it's the difference to the positive side because the net long number is bigger than the net short number. There's a lot of information about the COT online. I encourage you to read it, especially if you're interested in capturing the big moves. I'm trying to give you a whirlwind tour of some of the things that I use. Let's do this. Let's go forward. Just a moment, please. And let's talk about pre-holiday seasonals. One of the best books ever written on seasonal trading, or for that matter, any trading, is a book entitled The Behavior of Prices on Wall Street by Art Merrill. The Behavior of Prices on Wall Street. It's out of print, like most good books are, but it's definitely available, probably $100. But either way, Art noticed something very different. In the 1950s, he was way ahead of his time. He had developed a pattern around pre-holiday markets. He noticed that in the Dow Jones Industrial Average, the market was up the day before major holidays. What does that mean? Example, we have Thanksgiving coming up in the United States. It's a legal national holiday. Thanksgiving occurs the last Thursday of every November. So if the rule that Merrill posited is correct, and if the pre-holiday behavior is correct, then Thursday is the holiday this month. In fact, I'm giving you a trade. Let's make some money. Thursday is the day before. I'm sorry, let's start it. Thursday is Thanksgiving Day. It's the 25th. The rule that Art Merrill developed says that on the 24th, which would be Wednesday, the market should be up in the Dow Jones compared to the day before. So if that's the case, and the pattern occurs on Thursday, and the up day occurs on Wednesday, you want to be a buyer on a close of trading Tuesday and exit on a close of trading Wednesday. It's a simple one-night stand. That's all it is to it. I encourage you not to believe me. I encourage you to go and look for yourself. What happened last year, the year before, the year before, the year before. Throughout all of the probability studies by Art Merrill, the vast majority of legal U.S. holidays was up on average 74% of the time, which I think is a pretty respectable number because, looking at statistics again, the odds of a random event, in other words, could this type of behavior occur as a random event, the odds are less than 1 in 10,000 times. So you're not dealing with a expectation. You're not dealing with an opinion. You're not dealing with a myth. You're not dealing with an analysis. You're dealing with a fact. So let's go forward and let me show you something. Here's a list of major legal holidays in the United States. And you will admit this trading strategy is very different than what you've been accustomed to or exposed to, because this is based exclusively on numbers. And like all good trades, it's accompanied with an entry strategy, a stop loss, a profit target, and an exit strategy, all of which are known ahead of time. So I already know what I'm going to be doing in a couple of days, in about a week. I know where to get in. I know where to get out. There's also a specific strategy that I use for a stop and a first profit target. And think about this. What if you're an options trader? What if you're trading short-term options? This is very, very simple for you. You know when to get in, you know when to get out, and you know that your maximum loss, if you're buying a call option, your maximum loss is going to be the cost of the option. And that's all there is to it. Now, what are the legal holidays? They're right over here. Now, I've excluded from this list, not for any bad reason, I've excluded the birthday of Martin Luther King, and I've excluded Juneteenth. Why? Unfortunately, there's not enough historical data. I want to see at least 50 to 100 years of data before I can start calling a pattern a pattern. So that's very important to me. I like to trade with the odds. If the odds are in your favor, it will make your job a lot easier. So we just had the Columbus Day holiday, which was no longer called Columbus Day. It's called Indigenous People Day. But if I'm not mistaken, so far, every seasonal and pre-holiday trade this year has worked extremely well. And it's also giving you specifics on when to get in and when to get out. Let's do this. I want to talk to you about something I call spread of effect. And by the way, this is what the pre-holiday season looked like for Veterans Day. Okay, here was the holiday. This was the entry, and this was the exit. This was a Monday, if I'm not mistaken. This is a Friday. This is a Thursday, right over here. So let's go forward. And let me show you something else. I can search for trades and tell you right now what the patterns have been. I believe that there's what I call spread of effect. In other words, in Thanksgiving, which is the 25th, it's not necessarily the case that the market only begins moving up on the day before. It is possible there might be what I call spread of effect, that the seasonal effect actually begins earlier. So how am I going to research that? I'm going to switch screens here. Just one moment, please. I think I can do it. Here we go. Let's stop the share. One moment, please. Let me move something out of my way. Stop the share. I'm going to go to a new share. Just hang there with me, folks. I'm not a Zoom expert, even though I've done hundreds of webinars. Zoom still gives me trouble. Here we go. I'm going to share the screen. And I'm going to log into this website, seasonaltrader.com. I'm going to show you something very interesting. Here we go. I assume you're all seeing my seasonal trading charts. If you're there, David, can you just comment, tell me if you're seeing seasonal trader charts?
Yes. Yeah.
Thank you very much.
Seasonaltrader.com. Yeah, I see it. Looks.
I'm going to do a search. I'm going to say, go to the S&P 500, like so. I want to show you how easy this is because we're dealing with numbers. S&P 500 right over here. Check market. I'm going to go to the section on the right, say November. I pick the month of November over here. I'm going to go here and say, show me seasonal patterns that have been right at least 70% of the time or more over the course of many years. I want to see short-term trades. So show me trades that are 35 days or less in duration. So I'm asking the computer to do something for me. Call it research, if you will. The research is very simple. It says, really, really, really simple. Think about it for just a moment. One moment, please. I have an important message. Just bear with me, please. I usually don't do this. This is kind of rude. But I do need to do this message. Bear with me. Here we go. Okay, I'm ready. Okay, so I'm saying to the computer, find me trades in S&P 500 futures for the month of November that have been right 70% of the time or more since the start of trading in S&P with a duration of 35 days or less. If this animal is in there, it will find it. If it can't find a trade historically that has had this kind of performance, it's going to say, no trades match your criteria. So let's look. Here we go. And remember, this is all about the numbers. It's not about an expectation. It's not about a fantasy. It's a fact. So here we go. And look what it's found. It's found me some trades with 92% probability, 89% probability. Amazing. Let's take a look at what this means. Oh, so what I did was I said, show me trades with no stop. I'm going to go back because 100% stop is not the way we trade. I'm going to go back here like so and return to the search. So just hang in there, folks. Return to the search. I'm going to say, I want to stop. I don't want to risk more than 15% on this trade. So I'm going to come right in here where it gives me the option to pick my stop at 15%, like so. And I'm going to say search again, but this time put a stop in there. Here we go. Guess what? The computer has organized 59 pages of trades that meet my criteria, and it has put the highest probability trade in the first position, which is buy November 2nd, get out November 6th. Well, that has already happened, and it was a big whopper of a winner. But here's the interesting thing. What does the history of this trade look like? Ask yourself the question, for the trade that you want to make, using the strategy that you want to use, is there a history? Are there numbers behind this history? Let's look. Here we go. And here's the performance. Hypothetical performance every year back to 1998. And here are the results year by year. And here's the cumulative graph right over here. I would say that's very impressive. And it has everything we need: a setup, a trigger, and follow through. Fascinating. But guess what? This is not the trade I was looking for. What do I mean by that? Let me show you. You'll notice this is a very short-term trade. It's from November the 2nd through November the 6th. It's already happened. But let's go back right over here. One moment, please. Let's go back right over here. Sorry about that, folks. I want to go back to where I was before. Hang on a second. Okay, come on, guys. Just a moment, please. Go back to my share. And let's bring up the share. Here we go. Okay, so we're back. So let's do this. I want to find trades in S&P for the month of November. Just one moment, please. Getting into a little trouble here. Let's stop the share and come back to it. So just hang on 1 second, please. We'll be right there. Let's try it again. One moment, please, folks. Just got to find the right location. Don't you worry, we'll find it. Just a moment, please. You will get there. Let's do this. Let's go back to where we were before. And we'll start over again. Here we go. And let's do this. Let's go back to our share. And let me go to a new one. And take a moment on this. Very important what I'm about to show you. Let me do one more thing here. Very important what I want to show you. Let's try it again. It's hiding out here somewhere. Just hang in there, guys. I will find it. What I wanted to show you is this. There are trades all month prior to Thanksgiving holiday on the long side. That's why when you get a decline, as we've had in the last few days, it is usually met with strong buying as part of that November seasonal effect. So just hang in there. I'm still looking. If not, I can go back to the presentation. Probably do that a lot easier. So let's do that. Let's go back to the presentation. And Go full screen with it. One moment, please. Okay, let's do this. Let's come back to where we were before. And go full screen on it, like so. And here's where we were. So for example, when I do my search, let me show you a different one. Let's go to over here to 4th of July. The 4th of July is another major seasonal holiday with very high probability. So you would buy on the close of trading the 2nd of July, get out on the close of trading the 3rd of July. Question is, do these trades happen before? So when I do a search for July, for example, I end up with an 80% probability trade right over here, July 10th through July the 20th, July the 15th. But there's an earlier trade, and it's right here, June 28th through July 22nd, and I'll be able to get all the statistics for this. What I want to stress for you is the following. Number one, I know when to get in. I know when to get out. I know the probability of success for this procedure. I know my stop. I know my PL ratio. I know my average percent win, my average percent loss, maximum consecutive wins, maximum consecutive losses, super important information. And they can take that information and use it in a solid strategy and run all the results. So here, for example, is that trade I just showed you. That is all the statistics right over there. Now, people will say, wait a minute, you're telling me that with all of the international news that's going on, the war in Europe, the war in the Middle East, war brewing everywhere, the behavior of North Korea, the behavior of Russia, etc., that this trade is still going to continue to work. I want you to look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 years in a row, this trade is profitable. The average trader will look at this and say, there's no way this can continue. It's gone parabolic. I won't do the trade this year. Besides, look at all the stuff that's going on internationally. Well, guess what? The trade worked this year extremely well. What about next year? What's the excuse going to be then? In addition to that, we can graph the trade. We can say, how does this look on a historical basis visually? So this is a period of time highlighted in yellow that the trade occurs. And you can see not only has the trade been profitable, but also it encompasses a fairly large move if you measure the magnitude. Earlier in the session today, I showed you the weekly seasonal patterns. These are the weekly seasonal patterns. Same for futures, not for stock. You can see there are weeks up, there are weeks down. These are high probability weeks. And remember, in the big picture, I'm showing you a setup, not a trigger. Every setup needs a trigger. And for the trigger, we use a moving average strategy, which I will teach in further sessions. Now, let me show you the trade of the year right over here. Buying Dow Jones, end of day, June 27th, getting out. Wait, that's not the one I wanted to show you. Hold on one moment, please. Here we go. June 22nd, right over here, June 27th through July the 15th, going back all the way to the 1920s. Now, I want you to think about that. Who in this business is willing to look at data that's over 120 years old? How far back does it go? It goes all the way back to the 1920s and gives you the statistics. If you put those statistics on a statistical test, you will find that this event can occur by chance once in less than 10,000 times, more than 10,000 times. So it's not a theory. It's not the Elliott wave theory. It's the Jake Bernstein seasonal fact. And this is what the history looks like, by the way. Year by year by year. Yes, there have been some losing years. You can't trade without losses. Yes, sometimes the average losing year has been bigger than the average winning year. No problem. Is there a way to take care of that? Sure, absolutely. The way to take care of that is with an option or an option strategy. You know how long you're going to be in the trade, you know the expected move, and so forth. Do not make the rookie mistake of saying it can't happen again because, remember, the computer did not take into consideration any fundamental news, just numbers. That's all it is numbers. So as I said before, you can believe me now or you can believe me later. Let me show you a couple more things before we run out of time. And by the way, my annual forecast for 2025 is coming up in the next few weeks. I'm also having a day trade and short-term trade webinar over the course of 3 hours at the start of each trading day, starting on a Sunday and at trading real trades on Monday and Tuesday to show you how I do it. So let's go further on the slides for just a moment. I'm sorry about the mess up before. This is all the history right over there. And I want you to again come in and look at this period of time that we're in right now. Very important period of time, predictably bullish. And again, not based on expectation, not based on opinion, but based on facts. So let's do this. Here's a similar pattern reflected in the NASDAQ. Well, here's the NASDAQ pattern, June 29th through July 16th. You can see the statistics. And the best of all, you can run them yourself if you want to. Let me show you one more thing. I want you to look at this daily seasonal stock chart, composite of all the S&P, all the NASDAQ 100s since 1985, showing you some very interesting patterns. Take a look specifically at this pattern here from July the 10th through July the 15th. You can see the arrows up. You can see the trend. Very important. Now let's do one more thing. Let's just go forward again. These are some of my timing indicators that I use to validate a seasonal trade. And let's take a look at this. Just one moment, please. Okay, here we go. Going from November the 1st to November the 20th. It's right over here, this trade right over here. 78% accuracy encompasses the pre-existing, or what I call the spread of effect, for a seasonal trade due on November 25th, Thanksgiving Day trade. So let's see what happens. Check it out. See for yourself. Let me do one more thing. Let me show you my contact information and then turn it back to David. If you're looking to reach me, here's where you can be reached. I can be reached. My email address. If you have any questions. If you have any questions that I did not answer before, please get in touch. And remember, if you're interested in coming to my day trade and short-term trading webinar, my annual forecast, you go to the website, jakebernstein.com, sign up at the discount price. Don't pay the full price. Thank you, David. Sorry about the mess up a little earlier before, but I think I got my point across.